Hello and welcome back. In this edition of the Tracking Trends, we are going to be talking about the latest that has come out of the United States. And what's the latest? President Donald Trump, in a statement to a news channel there on Sunday, did not rule out the possibility of a recession hitting the US economy in the coming quarter. He said that in response to a question. He did not directly say when he was asked, does he fear recession? He did not say yes. What he said was that the US economy is in a transition. And of course, then he went on to argue that this is for the larger good, this is for the longer term good. But the markets worldwide, when the US market opened on Monday, did not take very kindly to the statement that the president had made. It plunged, and there was a cascading impact across the world. Yesterday, the markets in Europe tanked, and today we have seen a sell-off in Asian equities. The Indian market is also somewhat down. But the question that we are going to be dealing with today is there was a time when Donald Trump came with a lot of optimism among American businesses. Is that optimism now giving way to a sense of pessimism? And it would seem it indeed is giving way to pessimism. And why suddenly the table has turned? We will talk about that. And I have with me Dhananjay Sinha, an old friend of mine, a trained economist, and who is now the co-head of equities, economists, and strategists at Systematics Group. It's a Mumbai-based investment banking and equity broking firm. Dhananjay, welcome to the show. Let's get straight into the topic.
Sure.
America now fears recession. Why?
So I think I think the people are generally starting to understand the reality of whatever is being promised by Donald Trump and the way he's implementing the protectionism across the world, the retaliatory action that he has actually been implementing across Canada, Europe, Asia, India, China, etc., and across the world. I think that people are trying to get terms with that. If you look at when Donald Trump was being elected, the expectation was that he will be a pro-business president. There was expectation that profitability for the US companies would continue to soar high. It was doing very well. And with the reduction of the war risks that were there, people were generally very buoyant about the outcome. But I think as the reality is starting to dawn, what is being understood is that the promised reduction in inflation, the promised increase in productivity, etc., is not really panning out. In the short term, what we are seeing is that there is more of hoarding that's been happening of goods and goods that's translating into high inflation, and also the fact that as they are trimming the size of the government, it is actually translating into a sharp reduction in the employment. So the robustness in the job market is actually plunging quite significantly. And I would say that what it is also doing is that it is actually taking away the consumer surplus because the inflation is good, prices are going to be higher, and also that it is actually having an adverse impact on manufacturing sector because the cost of raw material would also increase because of supply shortages. So I think what the market is actually looking at this juncture is a diagonal shift from a significant optimism from the new president and the reality that is biting the economy in general. So I think the assumption that is now being talked about is that the U.S. economy may swing from a robustness to a recessionary situation very quickly.
Right. You said the reality is beginning to bite, and we are kind of getting to see that. On Friday, the US jobs data came out, and it clearly shows that companies are jittery about hiring. There has been a spike in part-time hiring, which means companies are waiting and watching, and they don't want to commit to full-time hiring. We have seen that employment generated in February was at a pace that was at a 3.5-year low, and we also see the decision of Elon Musk, rather the initiative that is being led by Elon Musk to downsize the government, is taking roots. There was government employment was down by about 6,000, but the fuller impact is going to play out in the month of March. We'll probably see data that could be worse when it comes out in April for March. So yeah, the US jobs data are a key indicator about the health of the US economy, and that's not looking good. And as you said, this is kind of undoing the most basic premise of Donald Trump's promise that, if I raise tariffs, one, I will bring in more revenue, I'll create more revenue. Two, I will create opportunity for the manufacturing sector, and companies will expand their business, and therefore they will hire more. So Americans will benefit both by way of higher revenue realization and also by way of higher job creation. But that's clearly not happening, at least not on the jobs front. So
Correct.
this has kind of backfired, right?
Sure. Yeah.
I mean, why couldn't Trump see it through?
So I think, see, what Trump has in his mind is something called golden age. When he sort of addressed the Congress, he talked about the fact that the golden era of the US has started now. So basically, he's actually reminiscing, history of 1800s and post Civil War,
the late 19th century.
Post Civil War, 1862 and all, where you had a phase called Gilded Age till the First World War. There was a reduction in the public debt, and they had increase in tariffs, etc. There was a lot of innovation, etc. that happened, scientific innovation, etc. Increase in productivity, emancipation of black labor, etc. So basically, he's trying to replicate something that US has done in the past. See, what he is not understanding is that the situation has actually considerably changed, with the dominance of other countries actually rising. So if you look at China, for instance, as a percentage of global GDP, it would be roughly about 18% odd. I would say if you look at 70s, it was about 3%. And China is roughly 1/3 lesser than US. So you have a very strong contender in the global south, which is dominated by China, whereas US is trying to go back into history. China is trying to look forward by way of technology, innovation, etc. So I think there is an anachronism in terms of the framework that he has, and it's quite possible in the reality of current scenario it might actually fail. So that's a broader context. I think based on the calculations that we have done, if we assume his original framework that he wanted 50% additional tariff on China and uniform 20% tariff on rest of the world, we estimated that the revenue benefit that US would get would just be about 2.3 or 2.4 trillion dollars in a matter of 10 years, because the tax revenue that you get from higher tariffs would also be compensated by the losses, offset by the the losses as far as consumer surplus and producer surplus is concerned. Versus that, the output loss that would happen would be in the region of $7.8 trillion in 10 years, which means annually they would have lost about 2.3 percentage point in nominal GDP. And versus the projection of 4.8%, that brings down the nominal GDP considerably. So if you have a stagflationary situation in the current scenario where the short supply translates into higher cost of living or higher cost of production, that would translate into a recession for the US. And the thing is that it has got ramification for the rest of the world also, because there will be a considerable contraction in the world trade and would impact emerging markets as well. So I think Trump is having an isolationist approach, wherein he thinks that if you sort of indulge into tariff war, it will actually benefit US. I would say that it is not a viable scenario even in the medium term, and definitely it is adverse from a long-term standpoint. So I think what we are seeing as a reaction today is an advancement of that scenario in terms of the outlook. I would say that the full impact of whatever he's doing will pan out over several quarters. I would say maybe several years as well, if he continues on this path.
Unless there is course correction.
Yeah. So the thing is, yeah. So the thing is, my hunch, I would say this is still a hunch, maybe speculative, that once he starts to understand the damage that it is doing, the whole strategy is doing to the US economy, and the loss in market capitalization that would happen, I think it will prompt him to roll back some of his stridency that he has been articulating at this juncture.
So what you are suggesting is the gravity of economics could weigh down, and
Yes.
there is a possibility that many of these things may get a rethink or a relook. But until then, a lot of damage might have been inflicted. And what you are suggesting is that the potential loss of output that you are estimating, if he has to walk the walk and talk the talk on the tariff front, that could be three times larger than the potential revenue gain.
Yes.
That would go down in the economic history of the world as one of the worst gamble played.
Yes. So the thing is, what we have said is that if you look at the levels of tariffs that he's been talking about, it is essentially the levels that were present prior to the Great Depression, 1929, 1930. So basically, US had very high, indulging very high tariff. There were tariff wars against Europe, and US actually charged extracted reparations from Germany because of the high public debt that was incurred because of the World War One. And not only US, other countries also indulge in reparation compensation. So I think you have a combination right now, if you look at it, similar to what it used to be at that point of time. So I think the risk is significant. I'm not saying that the outcome will be the same, but the risks are significant, and we are heading into a uncharted territory at this juncture.
That said, we have also seen over the last few weeks that Trump is also climbing down at times. He's making certain announcements and then holding them back. And the big day that everybody is waiting now is 2nd of April. And between now and 2nd of April, a lot could happen. A lot could happen. Now, the markets. But meanwhile, the market sentiments are not just looking up. So initially, we had seen Indian market was an exception. Some of the markets in the Chinese market and Japanese market were also impacted a bit, but most other stock markets actually had rallied upward, and now we see they're all on a course reversal. What's the outlook? Is that going to continue, or will there be a reason for the markets to look up eventually?
So I think if you look at the current scenario, assuming that Trump does whatever he has said at this juncture, it will be all dependent on what he does eventually. At this juncture, there has been some wavering because the trading partners have actually threatened that they would also increase tariffs and they would want to fight the tariff wars to the end. So I think there is some wavering that has been there. I think eventually what will be relevant for the US and for Trump is to see what damage it does to the US economy itself. So I think it is still in a state of flux in terms of how things would pan out. But assuming that there is certain amount of protectionism that would intensify across the world, we think that there will be a ramification for emerging markets in general by way of trade implications, the trade impulses for emerging markets. For India is quite sensitive to that. What happens to China and the dumping that would ensue from China because of surplus that would generate from reduction in trade. And I think that would have an impact on corporate performance by way of the way companies decide on investments, fixed capital investments, and hiring, etc. So I think that is a very important thing from a global market standpoint. And I would say that so that impacts the growth and earnings outlook. The other aspect is, of course, the capital flows, which would also get constrained because of rising protectionism. We have seen there is a very high sensitivity of capital flows, both FDI and FPI, to sensitivity of those flows to protectionism. So that would sort of impinge upon the flows. And the third part is that the uncertainty indices has actually been spurting. If you look at the VIX index, if you look at the market risk premium, it's actually rising. All those have an adverse impact on valuation. So you have a risk on earnings and valuation all playing together. I would say if you look at Indian markets, the market capitalization for Indian markets have shrunk by roughly about 94 lakh crores in the matter of 6 months. That's almost like 50% of household income. And I would say that since over the last several years, there has been a significant increase in retail participation because of digitization, etc. I would say that there will be a considerable damage by way of wealth effect to a large portion of individual investors. So it can have an impact on the way households spend their investment decision, the uncertainty, etc., can actually rise. So from a market standpoint, these are the implications, both from a fundamental standpoint and also valuations. If things turn, if let's say Trump backs off, let's say that is a possibility in the second half of this year, and let's say they get into a slowdown and they are pushed to cut rates, etc., then I think things can change and the valuations might start to improve after that. But I would say you have to really go through this whole grind before we arrive at that situation.
Yeah, thank you for bringing in the impact that gets mediated through the stock market meltdown that we have seen in our context, and its impact on its wealth impact and its impact on consumer incomes. You said that the shrinking of market capitalization is almost to the tune of 50% of household income,
Right.
And a good part of that would actually be the retail investors also.
Correct.
So in which case are we going to see kind of holding back on discretionary spending and other kind of investments, more asset creating investment activities by retail investors in time to come?
Yeah, so I think very genuine question. I would say what would happen is that, if you look at India, it's been a K-shaped recovery post-COVID, wherein the premium segment has actually done much better. If you look at cars or if you look at how, real estate, etc., and across consumer goods, there has been a significant increase in premiumization, wherein companies were able to charge higher prices for premium products to run their EBITDA expansion and profit growth, etc. So the wealth effect from from a contraction in market capitalization will definitely impact the discretionary spending and the premiumization story. On the other hand, we also see that the compensation growth of non-finance companies has actually started to slow significantly. If you look at the December quarter for non-finance companies, it's slowed to almost like 3 to 4%, and it has come down from a peak growth of almost like 16-17% 6-7 quarters back. So I think what you have is a slowdown in compensation along with wealth effect, which is negative. So I think you can have a combined impact of these two on discretionary spending. I would say what will be important from India's standpoint is what governments do. If you look at it, about 6 months back, Nestle was talking about contraction in middle income spending, etc., and a lot of companies actually resonated that view. I would say that if you look at the government, they have responded by reducing the income tax burden for the households, for the income earners, up till 12 lakhs rupees per annum. So there is a certain amount of stimulus that the government is trying to provide to the middle class. I would say the other aspect. Yeah.
Let me ask you there. Sorry, I mean this stimulus that we were expecting to come into effect from the next financial year, in a month from now, that to me looks like it's more than offset by what you are saying, wherein salary increases might have ranged about 3 to 4%, which is even less than the average inflation rate.
Right.
So there have been a degrowth in real incomes. And even if you get a few thousands rupees as your monthly saving, 10,000 rupees in the best case scenario, 10 to 11,000 rupees, that's not going to be a big investment.
Yeah, that's right. So if you look at the household income and the overall household income, including income earners or the wage earners, even the informal sector, I would say that the income tax cut is just about 0.3% or thereabout of the household income. So, and you're right in saying that it will sort of compensate for the slackness in the real income and the cost of living that's been going up. And also the fact that some of it can actually translate into import, etc. A lot of things have been said about this. So I think it's a very modest sort of stimulus. But the point I'm trying to make is that the government appears to be shifting its strategy earlier, which was focused a lot on investing in infrastructure and taxing households by way of income tax and indirect taxes. So extraction of disposable income by way of higher incidence of taxes is beginning to recede. I think we are still at the beginning of this whole cycle. I think I heard also that the government is considering reduction in the GST rates as well. So I would say that the way I look at policies is that fiscal policies will have very little leeway by way of spending, because the tax collection would actually slow less than what they had budgeted at roughly about 11% or thereabout. It can be there can be a shortfall there. Also considering the fact that they're giving income tax cut. I would say that their ability to spend, especially on the capex side, will be lesser. I think their focus will be a lot on livelihood issues, etc. And I would say that they have also pushed RBI to cut rates and push a lot of liquidity in the system. There's considerable amount of liquidity tightening that's been there. So I think RBI may be taking a more accommodative view. Also with respect to the regulatory tightness that it had implemented in 2023. So they have reduced the risk weight for bank lending to NBFCs. More deregulation may be in the offing. So if you recall, the economic survey talks about reducing regulatory tightness, and the budget also talked about it. I think RBI is implementing some of that. So my expectation is that the government might use whatever bandwidth it has on the fiscal side, but more so they will deploy RBI to do the firefighting at this juncture.
Great. I mean, we need to stay optimistic. We need to hope that the focus on consumption really plays out as it is intended to be. We hope that as we speak, there are efforts to work out some kind of a trade deal with the United States
Right.
that can hold the Trump administration back from announcing any kind of harsh reciprocal tariff measures on 2nd of April. Let us hope that the negotiators on behalf of New Delhi meet with success on that count. But until then, we need to keep our fingers crossed.
Right.
And until then, we need to go through some of the pain that we are seeing now, especially in terms of the volatility in the market, the meltdown that we have seen that's not going to be reversed anytime soon. But the hope is that eventually the gravity of economics catches up with US President Donald Trump, and
Right.
his domestic politics compels him to come to senses and start doing the right things. Thank you, Dhananjay. It has been a pleasure talking to you, and
Thank you, Rajesh. Yeah.
our audience, thank you for your patience. If you have liked the show, please subscribe to our channel, press the bell button, and keep coming back to us. Thank you very much.
Thank you.